Brent, I truly appreciate you and really the SpotGamma team who's been helping put this together. For you guys dedicating your time to come and actually talk with retail. And I think the timing couldn't really be better because the craziness we're seeing right now of the market was good. I believe the consumer sentiment report just came out. So I would love to get into all of that. But before we do, just a very, very quick introduction. Folks, for those of you who don't know, Brent is one of the co-founders of SpotGamma, the exact options tool I've been using. I believe as a company, the copyright you guys used to describe the company is a financial insights company, which basically you're giving people the underlying data of what's happening specifically in the options market. And audience, for those of you who might be thinking to yourself, well, why should I listen to this guy? And the answer to that is they're true professionals. Please correct me if I'm wrong, Brent. I believe previously you portfolio manager and then also worked as a derivatives broker. So your career has literally been not only in Wall Street, but specifically options. Is that accurate?
Yeah, that's right. I started in 2000. What's been so fascinating about this experience is that the options market's always been very large in the S&P 500, but options have exploded in use, obviously through the GameStop situation, zero DT trading, et cetera. So options have only become a bigger force. And so I've been really fortunate to be focused on this sector and this industry, let's call it, that's had a real growth path. And we see its fingerprints all over in market action every day.
It's funny that you bring that up because right now it's so common. I believe it's really the Wall Street Journal that loves to get into it of how like they just always documenting the explosion of specifically zero DTEs. And I'm just curious because like the media is covering it. And I've even seen some larger Wall Street players get into the world of like, oh, it's not good. It's ruining everything. I'm just from a pure data standpoint, is that also what you and the company are seeing? Like, is there actually measurably a higher amount of just crazy zero DT stuff? Or is that more of just like media headlines?
The volume is real. Call it 50% of S&P 500 options volume, which is the largest kind of options complex, we would say, is zero DTE trading. So those are options that expire today. There's very little open interest. So at the start of the day, there's not much of a position. There's a ton of volume that happens throughout the day. Those options all expire, and then we do the same thing the next day. And so that's really been responsible for the growth of options, call it 2023 to today. And the effect of that, in my view, is that it generally brings mean reversion to the market. So what do I mean by that? It means the highs get sold, the lows get bought. And with that, you have less market movement on a given day due to the impact of zero DD options in the S&P 500. That's separate from single stock weekly volumes. The options expire every Friday. Those are a huge chunk as well of volume. 40-50% of single stock volume is now just tied to the Friday expiration. And so there's a ton of flow. If you think about options as leverage, there's a ton of flow and leverage that's just tied to whatever the price may do either today or over the next couple of days. And so I think that has a big effect on the market.
Wow. Oh, I appreciate you indulging me in that. I was just curious because like I know sometimes in the world of like money and Wall Street, headlines are one thing, but maybe reality is a little bit different. Obviously, we saw that a lot with the craziness of like the whole meme stock media of like, 100%. Yeah, some things were accurate. Maybe some things were like half true. So I appreciate that. But let's hop right into why you're here. And I guess my pitch is, through my own experience in the world of really my comeuppance was very much in that world of, oh, wow, things are going crazy. We were all locked inside the stimulus checks, markets going nuts. And the thing that I thought was interesting is not only did we have these digital communities forming, and it was one of these things where to be in the community was a bit of tribalism where I thought a lot of inaccurate information was getting out there. Mm-hmm. And then at a certain point, I was like, oh, wow, there's people who kind of know nothing that are really like rising into prominence as an important voice, an influential voice. And I really have to take, like, that was me. I was like, okay, I know a little bit of market, but in relative to my following, I did not know that much. So ever since then, I was like, okay, the smart thing to do is take advantage of the platform and invite people on like you who actually know what you're talking about to get the proper information out there. And you could argue in certain things of life, like, okay, whatever, if you're happy, ignorance is bliss. But to me, this is one of the specific subsectors where truth matters because people's money is on the line. Like, obviously, financial health is on the line. That's not really the game to say, well, hang on, that's what I want to believe. They're like, no, there's a hardcore truth to what things mean, how things function. So once again, I guess I just wanted to say thank you for coming on. And I'm very, very interested because I think we could set this up where a lot of people who are obviously highly interested in option trading could maybe learn a thing or two and ideally avoid bad trades, find better ones, or just feel a little bit more comfortable with the terminology, how to use the platform, or really even how to interpret the market. So once again, thank you. And I'm loving the timing of this. Obviously, the market picking up and up. You know what? This is an even better view. Let's just go to the 1 minute of the SPY today. We're already seeing insanity. Nice little gap up on the S&P 500 ETF. Pop, pop, pop. And then at 10 a.m., which, yes, we have the macroeconomic event today of the consumer sentiment. Pretty large drop. But the way I've been using this, and this is honestly what I'm most excited about, is to talk a little bit about how to use the platform, how to understand this. So maybe before we dive into what isn't on the screen, you've already brought up the word gamma. And honestly, right here on the right, you guys might not be able to see it. I think my head's blocking it. But in the lower right, you can see that the right pane here is being measured of a measurement of delta. So very quickly for the audience, and maybe the people who aren't specifically like these expert option traders, what is gamma, what is delta, and why do they matter?
Sure. So when we talk about delta, the reason that we care is because it's an estimate of how big or how large hedging flows are related to all the options that are trading. And so if you think about 50% of options volumes being 0 DTE and millions of contracts trading every day, well, why does that matter to us as individual traders? It matters because there are, in theory, hedging flows from options dealers and market makers that will come in to help to mitigate the risk of all that options flow. So said it another way, dealers and market makers may have to buy large shares of stock or futures to hedge out all the options trades that are taking place every day. And so how do you estimate that impact? Well, the most efficient way we'd argue to do that is to look at what's called options delta. And an options delta tells you how many shares of stock you need to hedge a options contract for the next, call it 1% move. And so what's happening here on your screen is we're looking at every single options trade that is taking place across the entire US options market. And we're estimating on a dollar basis how big the flows are required and the direction possibly of those flows in order to hedge out those positions. So if Matt and you and your whole crew are out here buying call options in GameStop or whatever the stock may be, that means that someone's selling you those calls. And obviously they need to hedge that, and they would do so by buying underlying shares of stock. And you would see that as the purple line on your screen going up and to the right. And that tells us that dealers have to buy shares of stock in order to hedge their position. Those lines are going down right now in the S&P 500. And that means that dealers and market makers may have to sell futures or shares of stock, which if it's a large enough amount of flow relative to what's trading today, that should push the market down. So you can take this obviously from that high level, more technical perspective. I also like to add in a little bit extra flavor on that and say, let's just consider this as a sentiment perspective. If everybody out there is selling calls and buying puts, that's probably just a bearish indication of market sentiment, right? Okay. So you can really use that, I think, in both of those ways. And so right now you see that indeed the purple line is going down. The purple line is the delta hedging flow from all expirations. So we look at every single option trade that's taking across all expirations. As you can see, that's bearish and the market's responding and pulling back. Teal line measures the impact of 0 DTE options only. And so when you look at this flow, you should sometimes consider those as almost two separate flows. Yes, there's a lot of overlaps of that, but there are ways that people trade obviously on a 0 DTE basis. Like if I only care about what the price is doing today, I may act much differently than if I'm worried about where the market's going to go in 2 weeks, 6 months, whatever it may be.
Gotcha. And just because it literally popped up now, I'm seeing seemingly on this purple one, but maybe it's just in general, I'm seeing a flow alert. What is that?
So the purpose of the flow alert is to tell you what flow may be meaningful. So if you pull up a hero chart, you're going to find options volume obviously trading on every single one of the hundreds of names that we cover, right? But how do you know if that's meaningful flow? And so what the flow alert does is it tells you, look, there's a lot of options flow on this specific name occurring right now. And each name has to be independently monitored, right? Because what's big flow in Apple, what's big flow in like an AMD or a smaller cap stock is not going to be as big as something like Apple. Apple's obviously billions and billions and billions of market cap and billions of volume. That would, if you got Apple level notional value volume trading in AMD, well, AMD would go crazy, right? So you got to normalize the signal to each individual stock.
Gotcha. I appreciate that. Now, I want to come to the flow alert and I want to talk about it, but I have to admit, just because we're talking about this in real time, the thing that is catching my eye right now is specifically at 9:52. So if I didn't know anything was happening, like everything to the right of my cursor is just gone. I'm here at 9:52. I see the market going up. I see the flow going up. So, okay, in my mind, it makes sense. Price is up and there is, we'll call it bullish aggression in the world of options.
Yes.
Cool. Now, what's
And let
interesting
me just
is
interject there. It's primarily zero DTE flow. So the
primary.
fact
Okay.
that you see that teal line very, very tightly related to the purple line tells us that the only thing happening right now is zero DTE, which I think is important.
Okay. And then I appreciate that. But the thing that's really jumping out to me here is right at 952, price was still seemingly cruising sideways. 952 is where my cursor is right now, sideways. In fact, we went sideways for about another 8 minutes. But I guess the way I've been using it is not getting into dumb positions. So say I'm sitting there at 953 and I'm thinking to myself, oh, this looks pretty good. I like the cloud. I like the trend. Maybe I will follow up bullish with it. I turn over to this. Something just happened. 952, all of a sudden the options market turned, which I don't know if maybe we should be interpreting that as go bearish, but the way I've been thinking about it is like, no, just you should wait because clearly there's a mismatch right now. And whenever I see a mismatch where I see price doing one thing and then the delta doing another thing, in my mind, I just interpret like almost like wait to see who wins out. Wait to see either the price comes down or the options come back up. But like I almost like to wait, and if I have a directional bias, I want to see the confirmation also with options. Is that a fair way to do it? Like if you yourself were sitting there at 955, would you be like, hang on, I just need to wait? Or would you actually go bearish, or would you, am I interpreting it wrong?
No, I think that's a great way to look at it. I mean, you know, in trading, it's about finding the best opportunity. And so when you're looking at that chart there, if you're long and your bias is, hey, I think the market's going to break out higher now, if you see those purple and green lines continue to the top right of your chart, then you know that the options market has a kind of wind at your back, right? It's a tailwind, it's supporting your view. You have to start to think about things when the options market starts to roll over, particularly if you start to see confluence of indicators, right? Oh, we have resistance. We personally wrote in our note this morning that we think the market's going to pull back to 5,200, specifically 5,200 to 5,215, which is 520. And so, you know, that's what our bias is coming in here. And when you see this volume start to roll over now, you say, okay, this is now kind of confirmation to me that we could be pulling back into that zone. Now, there are times, obviously, the market could go up and maybe the hero indicator doesn't necessarily agree with that. Those types of things happen. But if you're looking, in my view, for the best opportunities, it's when you get that options flow corroborating the direction of the market, which can often happen.
Very cool. All right. So as we're letting this play out, I did want to bounce this off of you. So this is from the FOMC day on Wednesday specifically. And for those of you who saw the stream, or if you want to double check what I'm looking at right now, it's about an hour and 30 minutes in. So this was the FOMC day where the white line was the price line and it just went absolutely bonkers on that day. It was right about here where apparently the world forgot about monetary policy and the devaluation of the dollar and inflation, and we were all just living a great life of paradise that apparently only lasted for about an hour. But what was interesting was I was sitting there and I actually was underwater on a position. Obviously, I had been a bit more bearish and I wanted to go bullish because I saw it ripping, and I just historically know that when Powell says something, it kind of seemingly trends for the day. But what's so interesting is I ended up not doing anything because when I was waiting there, I was like, well, price is going up. But I was watching the green line, which I believe you said was the 0 DT call. So calls were ripping. And then I saw that they did nothing. And then going through all of the education you guys on the platform, I was trying to learn more about the market makers. Like, well, hang on. If the calls drop, that means that the market makers might unhedge. And if they unhedge, they're going to dump the shares that they were buying to originally hedge. So I thought, if the calls dump here, the market makers are going to dump and thus price might dump. And then obviously, I mean, we all know how that day actually ended. Am I interpreting this right? Or did I just get lucky? We'll say.
No, I think that's exactly right. I mean, when we open the conversation today about talking about 0 DT and its impact, I believe it is this mean reversion flow. And why would that be? Well, if you have 0 DTE calls and you just made 5%, 10%, or more, obviously, on those 0 DTE calls, you can make hundreds of percent. You're going to close those out probably when you have the opportunity, particularly if there's only, let's say, 20, 30 minutes left in the day. You're going to monetize that position, right? Because it's going to expire in a few hours. And so if you just think about that, hey, everyone was long calls, they made a ton of money, and then they start to close those out, well, it becomes a feedback loop. Because if everyone starts selling their calls and you're long those same calls and you're like, market's going down, everyone else is selling their calls, like, I want to get something out of this, I'm going to sell mine too. They become reflexive feedback loops, we like to say. And so that pressure of the market for. And even if again, you don't want to buy into the underlying mechanics of dealer market making and hedging and all that, just take a sentiment perspective here. Well, everyone stop buying calls, right? Does that mean we're fairly valid? Does that mean the reaction to whatever Powell just said in his final comment today is suddenly bearish? I can also take information from that as well.
Very cool. And then another one I had here, but I think we've kind of covered this. Same thing. I think this was the stream for Monday where I said my favorite thing to do is avoid doing stupid things. And I hope you haven't watched any of my content, because if you do, you're going to say, oh, wow, like you have a proclivity for doing a lot of stupid things. So that's really how I've been using this. Where on Monday of this week, so let's rewind to that point. So on Monday, I was feeling bullish. And it was pretty early. It had to be before 11 because I was streaming. So it felt bullish and we went up. And then I was like, okay, let me just double check. Let me see if I'm understanding this delta gamma thing properly, because we popped. I wanted to go long. And then the question is that the right timing? Obviously, the bias on the day was the correct one, but the secondary question is the timing good? And I brought it up. And at that moment in time, I had noticed that options for then weren't agreeing. So I almost used it as a tool to say, wait a second, there's just some gyration, something's going on. So the confluences that you're referring to, it sounds like that was smart to actually wait. And I did use the platform properly of like, okay, if you're bullish, do you really want to be bullish when things are dumping? Because I saw this dump here. So I just waited. And I don't think I even got the trade until 1 p.m. because that was the time it like started to pick up. And like I was even discussing on the stream, like, guys, I want the bullish position. I just don't know if I'm doing it properly. And then eventually later in the day post stream. So it makes me feel like maybe I was doing some things a little bit smart rather than just getting purely lucky, but maybe to add a little bit more structure to this. I'm very, very happy and grateful that you kind of, wow, we're actually seeing this dump now. So that's interesting. We just saw options puke. And then the question is price puking? Let's see. Let's fast forward to some real-time info.
What you saw there with the purple line going lower, if you think about what that is, that's people buying puts that don't expire today, right? And maybe they're closing out short puts because obviously vol's really gotten compressed here and collapsed. But maybe look, next week we got a couple data points, whatever it may be, but they're expressing a view that goes out past today. And that does, in my view, is it changes the hedging dynamic out in time, right? It's not just today's thing, it's next week's thing. And so you had this moment in time where I think the market's overbought. We wrote about this morning. We know vol has collapsed a lot, and we're seeing that spread between the purple line and the teal line expand a little bit. And so I think that has a little bit of a longer term signal rather than saying, look, some zero DTE guy just like shifted his position. And so I can take a little bit more information away from that, if that makes sense.
No, okay, I see what you're saying here, because right at 10, it was tightly coupled. So this was a zero DT, either selling calls or buying puts, or most likely the combo of the two. But right now, yeah, people are getting a bit more bearish, or at least a lack of bullishness on zero DT, but you're seeing actually more aggression farther out.
Right.
Because of
this is not an end of day signal, but it does give you a little bit more validity for when you say, okay, look, I think the market's going to pull back. I obviously sweat when I write that in the morning note, because the last thing I want is the market to go up 2% when I say, hey, we're going to consolidate it 5,200. But when I see that longer dated flow coming down, I go, okay, like things are going according to plan right now, right? It's like the
interesting. Okay. Very cool. So to add a little bit more framework, I think we're all on the same page. If we get that you're overlaying the delta notional, zero DT, all expiration, we're using SPY as an example, and we're seeing how sometimes it is giving you the confluence, or sometimes it's a leading indicator, as it was today. We saw a drop, wait, see which way it breaks. I like that, but maybe to add a bit more structure here for the audience who maybe they're already on SpotGamma, someone like myself, or maybe some people are like, okay, I see the tool, I might want to use it. Is there 1, 2, 3 rudimentary ways where you're like, this is where I would start and this is how I would start? Like what's your go-to if you're an active trader? You log into the platform, what's like a strategy that you're looking at? Obviously, we're talking about the higher level things, but if we were to drill into it, where would you start?
Yes, there's a couple of important confluences, I guess I would say. So we start every day and we look at, okay, where are the major pockets of positioning, right? So 5,200 is what we call this call wall. And a lot of people kind of tease at that idea, but there's a lot of validity to it, not only because a call wall signals that there's a strike that has a lot of gamma, which tends to mean it has a lot of pulling power. We view those as support and resistance levels. So where are those big levels in terms of where the big strikes are? And that goes across single stocks as well. The second thing is, what is volatility doing? how high is volatility being priced? You can look at the VIX. You can look at individual options. We have a whole volatility dashboard that helps us put this into
Okay, yeah,
helps
I
us
have
to
it on
set
the
everyone's
screen right
expectations
now. I
around that.
found the call wall, and then you have the VIX, which I think I saw you guys even tweeted out this morning that the VIX is either at an all-time low or close to it, something like that. Like volatility is like really drying up.
Yeah. So what's interesting about this is that, for instance, we just had a data headline point, and you were talking about the Fed the other day, and I have a lot of friends, smart macro people out there, but I don't envy their position because there's so many factors involved in macro analysis. And we all know that there's expectations into these big data points, right? But what matters is not the news itself, but the reaction to the news, obviously.
Mm.
And I think that the truth in the reaction is in the options real-time flows that you see in Hero, but also what is implied volatility doing, right? Because if you think that what the Fed just said was the most bearish thing that you've ever heard out of your mouth, but implied, or out of Powell's mouth, but implied volatility does not react to that. In other words, the VIX doesn't go up, then guess what? It doesn't matter what you think. The market says it doesn't care.
Yeah.
And so a large part of what we watch volatility for is this idea of Vanna, which is essentially saying if implied volatility goes up, it tends to push the market down, right? So if the VIX goes up, market tends to go down, and vice versa. Well, that's not just a fear gauge. There's actually hedging flows associated with or driven by the fact that volatility, i.e. the VIX, is going up or down. Now, what's interesting about this is that if you look at the amount of volatility that the market is pricing for Monday, implied volatility is 7%. You say, well, Brent, what does that mean to me?
Yeah.
You can use this thing called the rule of 16. Divide whatever the VIX is or the implied volatility number that you're looking at, divide that by 16, and that tells you what people think the one-day move is going to be, okay? So Monday's implied vol, the vol from the option expiring Monday is 7%, which tells you that the market is pricing in 44 basis points of movement on the day. That's nothing, right?
Right.
So if you're an option seller right now, if you're out there saying, hey, I'm going to sell some call spreads or put spreads on 0 DTE or Monday or whatever it is, you're betting that the market's essentially not going to make any movement whatsoever. And so the risk reward at that point gets, in my view, not all that great. So that's what some of the thing that the options market could tell you. The other thing that tells me is that if you think about implied volatility as a flow to lift the market up, then a flows lift the market up. If the market is pricing in 44 basis points of movement, that means that there's no more fuel for the market to lift anymore, right? Because the expectations have already collapsed essentially to like their lower bound, right? Vanna as a driver is no longer available. Now, Vanna, if you just look at the VIX at FOMC, the VIX was obviously quite a bit higher than it is now, and the VIX has absolutely collapsed post 5-1 FOMC, right? So if you think about the VIX going down, it's fuel for the market to get pushed up. Well, the VIX is now at 1-year lows, right? So that fuel, that driver that helps us to push the market up, it's gone. And that's the same time they're at this call wall level, right? We have PPI, CPI next week. We have OPEX, which I think shifts positions, allow the market to move around a little bit. And you go right into it, NVIDIA earnings, right? So what I'm trying to say is the easy money, the squeeze, right? The fuel for the squeeze all has drained out. So I went into a lot of stuff here, I know. But these are all cycles of how you frame the market. So, when you look at this, we say, okay, yesterday was some of the lowest options volume we've seen in a year. We're above these call levels, which tell me that people aren't adding positions overhead. We see that, volatility, obviously, as I just covered, has been squeezed to a minimum. We're seeing negative delta hero flows. We know that next week has these data points that longer data traders are going to care about. All that tells me that we're a little bit overbought here. Things are likely to get very dull on Monday, and the risk reward of putting on big trades here is probably very low.
Okay, I appreciate that. Now, with it, to dive a little bit more, you probably didn't know this, but a lot of the times this is actually a game show, and you're the contestant today. And the name of this game show is, Did Matt Just Do Something Stupid? So I'm trying to interpret what you said, and I just want to make sure I understand. So right before you joined the show, I was looking at Microsoft, and I said, okay, I see a call. Well, the reason I was looking at Microsoft was, first of all, I was just looking at price, not knowing anything about options. And I thought to myself, you know what? Microsoft, strong company, maybe an overreaction. I see a potential reversion. We're over the EMA cloud. So my potential directional bias was a bullish one because I see, okay, it popped, it came down. Maybe we're going to get the follow through. I like this level up here. Maybe I can get some calls. So that was where I started. So I type into Microsoft and I come to the equity hub and I see the levels and it looks like we are getting smacked right at 415, where obviously SpotGamma has a call wall level. But I know enough about IV that I figure I should check that. The IV rank 5.7%. Now, everything I've learned about options is when I see IV so low, it's telling me that premium is very, very cheap. So I think to myself, okay, you're not so crazy. Maybe think about buying premium. I generally like to sell premium, but now it was so low. I mean, 5%. Like, so now it's like, can I get the directional bias right? So, but the bias was right. Should I buy calls now becomes the question. So once again, still on Microsoft, I came to, you guys have a platform under real-time signals called implied volatility, and I see it as red. Now, I went through the educational part of this up here, the what is this, and my understanding is if it's red, that also means things are cheap, and you could see it on specific strikes for specific dates. And then if it's green, it means things are expensive. So I guess, is that the right interpretation? And thus far, with the IV rank being so low and the whole matrix here being so red, does that mean that premium is cheap, or am I off base?
No, I think that's a very accurate assessment. And so, one of the things, if we went back to the GameStop saga, which I know you were really involved with, is that the options got so expensive that essentially the probability of them paying off is like zero, right? And so oftentimes I see it all the time. People get frustrated trading options because they're directionally correct and then they still lose money, right? Because they paid too much for the call, or they paid too much for the put, or they sold very cheap premium. So when I told you that implied vol was betting for the S&P right now, that 44 basis points of movement, that's telling you that the options are so cheap that the risk reward is just not there, right?
Gotcha.
So when you're looking at that red on the screen, if you flick to just term structure, say on Microsoft, people can probably understand this. The green line is showing you what we call at the money implied volatility for Microsoft. So if Microsoft is at 410, 415 in that neighborhood right now, what is the implied volatility of those options for every expiration out in time? That shaded cone is the range of that volatility over the last 90 days. Okay, so statistically, what does implied vol look like for Microsoft? Well, right now you can see that it is as low as it's been in the last 90 days. So that puts it into context for you that you can objectively say, look, implied vol is pretty cheap here for Microsoft. And so there's a few other dynamics you can dig into, but if something is very cheap, just generally speaking, you don't want to sell it, right? Doesn't mean you're wrong. If you sell a call and Microsoft doesn't go up, well, pat yourself on the back, you're correct. But in terms of options dynamics, the options here are very cheap. And generally speaking, you don't want to sell stuff that's cheap. You tend to want to buy something or just do nothing if you think that options are cheap.
Okay. And then also right here on volatility skew, I assume it's the same thing. The fact that it's below means cheap. So really, I think sometimes when there's quote unquote professional platforms, a lot of people automatically think, oh, they're just going to sell me to sell premium just because that's what Wall Street does. But you guys are saying, no. Like, you're happy to do both. You just want an extreme. You either want cheap premium to go long calls or puts, or you want expensive premium to sell calls or puts. Is that a fair way to explain SpotGamma of identifying extremes and then playing almost the reversal of that in terms of the value of premium?
100%. And so the issue is, some people, look, you have a strategy. I love to sell premium. I love to sell call spreads. A lot of people like to do that. But it doesn't mean that every day I want to come in and I have to sell the S&P 0 DT call spread, regardless of what the price is. I just got to sell it. I got to sell it. And the same thing with Microsoft or all these single stocks. Number one is, how do you verify that something is cheap or expensive? It's relative to every single individual stock. And then second, someone like me, I just want to make money, right? And if that becomes, in a situation where volatility is very high and I can sell spreads or something like that, great. If options are cheap and I think I can buy them and the market is mispricing them, because that's what this is all about, then I'm happy to buy options as well. And I think sometimes people get trapped in this idea of selling premium is the way to always make money. And while you might be right 9 out of 10 times, at one time you're wrong selling options, you can obviously lose money a lot of times as well, right? So I think that when you can objectively say, hey, this is cheap or this is rich, and I have a catalyst in mind and the market may be mispricing this, because that's obviously what you're betting on, then using these tools that put things in context, statistically speaking, can be very powerful, not only to put on a great trade, but to avoid a bad one, right?
No, I mean, that's how I've been using it. And now I'm starting to connect the dots a little bit more here. I have a question for you, but as you're about to say, I think it might be a little bit outdated and this might be a better real-time example. So someone asked, hey, I had, it looks like they had NVIDIA calls. And with NVIDIA, let me just double check that. NVIDIA, I believe NVIDIA did beat, but I just want to make sure here. So in their last earnings, NVIDIA did beat. It gapped up. So basically we closed at 670. Yeah, so it jumped up. But even with that, they had calls and still lost money. Right. So my question to you is that because most likely was this thing just very green and they spent too much?
Yeah, 100%, because that high volatility, what they paid for that option or those options was way too high. And so this is what the value of looking at things like volatility skew is and term structure, because you can be directionally right in options and still pay too much.
Okay.
And that's a function of two things. Number one, expectations. So how much movement do people expect? So market makers, obviously, and dealers are very efficient at pricing out probabilities. And then the second one is supply and demand. If everybody is buying calls, then that is likely to drive the price up. It's supply and demand mechanics, and dealers don't want you to buy calls anymore. They're going to raise the price up, and that does one of two things. Number one, it gives them more padding because everyone's paying too much for something. And number two is it incentivizes selling, which helps to lower their exposure in theory. And so that's why knowing what you're paying is so valuable, and knowing what you're paying on a specific instrument, because NVIDIA vol is at a different level, right, than something like Coca-Cola or even S&P 500.
All right, that makes sense. So right now, a lot of people in real time are chatting about this because GameStop has had quite the week, quite the half month, and then today it's going crazy. It went from 17 up to 20, down to 18 right now. Please, okay, I don't think you could say this, but I can. So right here, I see a green across the board for today's expiration, 510. So I think you would say it is statistically unwise to buy GME calls today. And I would interpret that as you're dumb to buy GME calls today. Am I right on your interpretation of it? Not necessarily mine.
Sorry to interrupt you. I would say, first of all, I have no idea what's going on in game. If there's some news like someone's going to buy them out, then that's a different story. But let's just say that there's no material news happening right now.
Fair.
I would look at the volatility skew tab that you have there.
Volatility skew.
All right, so bring that up. What you see there is 1 month skew. So what is the price by volatility 1 month options for GameStop? Now that shaded cone is the statistical range for 1 month options, right? Over the last 90 days. And so what you see now is calls, those upside strikes have a much higher implied vol than we've seen over the last 90 days, right? That's what that gap between that line is and that shaded cone. The other thing here is we say this is an increasing call skew. What does that mean? That means that out of the money calls are starting to get higher implied vol level than at the money. So where's the stock trading? You see the upside has higher implied vol. That is a signal of excessive demand. And so in this moment, you are starting to come into this thing and saying, great, I want to buy calls here. You are, in my view, objectively paying too much.
Okay.
Now, does that mean you want to sell those calls? I can make a very strong case for that. But maybe you're like, no, Brent, you're wrong. This thing's going to continue to move. Then you're paying too much in that view. Now the stock could continue to go crazy, in which case the implied vol could lift. That's the other side of this coin. But statistically speaking, you're paying more than you've paid at any point over the last 90 days for those options. Second, if you flip over to Hero for GameStop, you'll see another interesting element of this dynamic. You have this situation where call demand is increasing, which in theory means dealers and market makers have to buy the stock, right? And we hit this level, 20. And at that moment, we suddenly saw everybody start to come in and sell calls. And it's starting to get not a massive amount of flow, but it's signaling that people are starting to unwind those call positions.
Oh, whoa. So the orange line, which I believe is the all expiration calls, just done. Like that's actually what's been dragging it down. So
yes, we
this is fascinating to me.
The call wall. The call wall tells us where most of the calls are struck in from a gamma perspective in GameStop. So we hit that level and immediately call sellers come in.
So I guess, and this might get a little bit in depth, but I think that it's important for people to be successful. Why, when hitting a call wall, and I assume like the opposite is true, but why, when hitting a call wall, does that like mathematically serve as resistance? Like what's going on there with market makers that they're like, oh, okay, we might actually get rejected here?
Yeah. So if you look at that The previous chart, you don't have to flip to it, but the previous chart showed us that call skew, right? Out of the money calls having a very high implied vol. That tells you or informs you that people are long calls in GameStop. If there are short calls, that skew wouldn't be so elevated. Okay, so we know traders are long calls. That means dealers are likely short calls. And what happens, in my view, is that when the stock moves up to the call wall is the level, the strike that has the most calls assigned to it. That means that when we get into that level, when the stock gets in that level, delta is at 50, gamma is at its highest level, and I think that is what brings out the options hedging flows. It's an obvious place for people to monetize positions and for hedgers to come out and adjust positions. And so that is the theory as to why it's a significant strike. Now, what we actually see in practice is things like this all the time, where we hit this big level where all these options are struck, and people go, great, I'm going to sell this position, I'm going to roll this position, I'm going to close this position, whatever it is, it changes the hedging dynamics, and we pull back. And it's been a pretty violent pullback, as you can see there.
Yeah. Oh, okay. And so it's kind of interesting as I'm putting this together. So not only did we have some craziness, but it was interesting because when we started this call, I said, oh, call wall. And at that point, we hadn't dumped yet. But it's more that like, we see, yeah, there was some zero DT, but it's more so longer dated. So you had people who must have been paying attention to this for a while, clearly not paying for today, the 10th, playing for a while out. And maybe there is that psychological thing of, I bought the 20's now hit, happy to take money. And I found that a lot of the market seemingly is a self-fulfilling prophecy. Just because other people start doing it, that makes other people do it, which makes the whole thing become real and right there. And then as soon as it starts to dump, well, no one wants to be the guy holding the bag. So then they sell. And then that's why we just saw it dump and dump and dump. So obviously, I don't believe that the consumer sentiment thing helped at all with the overall market dropping. I'm sure there's some weird mathematical impact. But I also want to point out, puts have done nothing. No one's buying or selling puts. This is a game of should you be buying or selling calls. Like puts have been flat this whole day.
Correct. And you generally want to avoid buying puts when implied vol is very high as well, because if the stock comes down, that can be a tax on your position. So you want to look at put spreads or something. If you're sitting here saying, Matt and Brent, you guys are idiots, like GameStop is going to go to 50, well, then maybe you want to buy the stock instead. Maybe you want to, sell a call against it out of the money or something like that. Maybe you want to put a counter spread. There's other spreads you can do. There's other things you can do to express a position in a high volatility environment. But we're just sitting here telling you, look, just buying a 1 month call or a short dated call, even, you're paying too much. Which lowers the chance that you're correct, right? And so if you want to talk about avoiding mistakes, you can still have a bullish view on the stock. Doesn't mean that you're not overpaying for the option.
Yeah, I think that's a good note here. Like this stuff doesn't necessarily mean we hate GameStop and it's going down. It just means 100%. If you're exclusively buying calls, you're just overpaying for it. And it still might work. I mean, I always use poker analogies, but you could be dealt a 2-7 offsuit and still win. It's just more of if you apply that methodology many times, what would be the most likely outcome after like a large, I guess, attempts at that same methodology. So this is simply saying, and here, let me just go back because I think the visual is very, very helpful, is if you buy implied volatility, you're just paying too much. If you're buying calls right now or puts, like I believe it cuts both ways, right? Like this is just literally saying premium is too expensive. It's not necessarily a directional bias. Is that right?
Yeah, and it's a function of market expectations and then that supply demand issue. And so if everybody thinks GameStop is going to go up and they're buying calls as a result, that drives the price up, right? The price of the options up, and eventually you hit these bounds. And this takes us back to the NVIDIA example where those options can't pay off. Stock can still go up and you could still lose money because you're just paying too much for those options. And so, this is a consensus thing. It's a supply demand thing. But this was one of the things that, I stopped talking about the GameStop stuff in a lot of ways because back in 2021, I mean, you'd kind of stick your neck out there and be like, look, you guys shouldn't be buying calls because they're just too expensive. And then people would say that you're, trying to stop the movement or whatever. And you're like, no, we're like, you're just paying too much. Doesn't mean you're wrong about the stock going up, but you're just paying too much to make that bet, in our view. And if you think about it, anytime you trade an option, you are betting that the market is mispricing that option. And if you can identify why it's mispricing it, then maybe you have an edge, right? But you're essentially saying, look, I'm smarter than the crowd here by buying this call or selling this put or whatever it may be. And if you can say, oh, I know this is too expensive because of the supply demand issue, then great, because I think that supply demand issue is going to change. Or we're looking at Microsoft. Is there a catalyst ahead that the market hasn't figured out, the market isn't pricing in? Those different things, right? That's where we find our edge. and understanding why there's a mispricing, and then thinking that we can then, that our view is going to be better than or different than the street's view of what's about to happen.
I obviously appreciate the information, but now I'm actually feeling more dumb on my play because I see calls going flat, puts picking up, and longer duration calls being sold. So the information is useful, but it's making me feel less confident in my new Microsoft position. But on that note, maybe I'll be able to make it back because we were talking about the other high flyer, NVIDIA, and I just want to double check that I have my dates right. But I believe NVIDIA does have an upcoming earnings. Okay, so this might be like, I know we're looking at things historically, and when I luckily got the FOMC right, we're looking at real time. So maybe let's look ahead a little bit. So NVIDIA is earnings, I just want to make sure I'm getting this right, is Wednesday, May the 22nd, which I believe is, okay, it's about a week and a half out. So I would love, so for people who are interested in playing earnings, if you were forced to play NVIDIA, where would you start me? I just typed in NVIDIA. What should I do?
Yeah, I want to set the stage here because I think this is a super interesting environment. We talked about the macro level, and look, if anyone found my diatribe at the beginning about the cycle of options, email us and we could set up. We could discuss that a little bit further. But we're at the start of what I call the cycle where volatility is very low, right? The VIX is low, pricing in very little amount of movement. We have catalysts coming up. We have CPI, PPI next week. If that inflation number is different than what the market expects, then there's going to be a bigger reaction, right? We have options expiration, which resets positions, allows changes in movement, changes in volatility. And then we immediately move to NVIDIA. NVIDIA it's the king right now, right? And I think that's kind of undisputed. It's the number one stock in the world, I would say. And if it crushes earnings, then maybe we're all going to move up. If it bombs on earnings, then people just suddenly will abandon this AI theory, and who knows what happens, right? So that event is on the 22nd. So we have all of these catalysts coming up at a time when volatility is very low in general. And so I think it's a very interesting time to start looking at some longer dated options. So if you bring up NVIDIA volatility skew from a 1 month basis, generally what happens in single stocks is when there's an earnings event coming up, implied volatility gets very elevated. Right, that's just a natural function of what happens. So in this case, this is 1 month skew for NVIDIA. And what we can see here is that we're elevated, right, but not as high as 90 days. Now, the last 90 days had some incredible movement for NVIDIA, right? We hit 1,000. We were just going up every single day. It was just going crazy. So this is actually fairly muted. Now, this volatility could pick up a little bit over the week as we get closer to earnings, but I see two things. Number one, this structure is very flat. What I mean by that is that straight up line is where the stock is trading. And you see to the right or left of that volatility is very flat. Okay. So what I want you to do, if you don't mind, if you click that little 3-line icon up in the corner there. Yep. And I want you to add, if you go back to 3/15, which is March 15th.
3/15. Got it.
And then in the expiration, add a 28 or 30 days to expiration option.
20. Can I add both? 28 and
yeah, you can just pick one.
Okay, 28.
Okay, and then the last thing at the top there, you see where it says percent moneyness?
Yes.
Click that one.
Okay, so 3/15, 28% moneyness, and then add?
Yep. Sweet. Okay. So I just made Matt do all that because what I wanted to do is I wanted to compare the current NVIDIA 1 month options versus what the 1 month options are pricing back into the NVIDIA conference, which was a huge event, right? It was like, everyone was watching that GTC event thinking that they, it was like the Steve Jobs things, like, what are they going to announce? Oh my gosh. And so what you see here is that, remember I said that the current structure is very flat, right? If you see the same comparison to that big event before in mid-March, you see that gray line is much more elevated for calls, right? For upside strikes. Gotcha. So on a relative basis, if you think about it, the calls were very expensive back in that mid-March timeframe because everyone is expecting the moon right out of that. And it's so hard when the market expects, like if you, I was talking about my wife, like if you're expecting me to bring 5 dozen flowers to you tomorrow for Mother's Day, and I just bring 1 dozen, you go, Brent, like you're a jerk. But I'm like, hey, I brought flowers. So the market is expecting NVIDIA to blow it out. Well, if they blow it out, then great, you met expectations. And what happens? Well, it just turns out you paid too much for your call because NVIDIA blew it out like you expected, right? If they do something less than blowout, then suddenly you still paid too much. So in this case, the market is not as expecting as much, I could argue, out of NVIDIA or as much as they have in the past. So does that mean you want to buy calls? Maybe not. But what it does tell me is that the expectations are not the same, which means that if they do produce good numbers again, the market reaction in terms of the stock going up and staying there could be a little bit more meaningful, right? And so that's
Gotcha.
what I'm taking away from this into this major event. Now, because those lines are up against that shaded cone, overall options are still as expensive, but we don't have that huge call imbalance, right? That call demand imbalance just told me that everybody's long calls already. We don't have that same skew to the data.
Gotcha. Okay, so
And so,
yeah, it's always this the market's own measuring stick, and right now, like you said, you can crush it, but once again, if the expectations were higher, you actually just it doesn't go well. So when people, I believe at that moment, whatever, back in March, I mean, I believe people in my chat 800, 900, 1,000, and even though we went up so much, I believe the volatility just got crushed. So even though
yes,
they got the direction right, which is really the bane of a lot of new option trader and probably even advanced option traders' existence, is getting it right and still somehow losing money.
it's the most
And
painful thing
this
about
is, to my understanding, the almost the visual of the math behind why is you're simply paying too much. So right now, and like obviously, we're not trying to in any way, or at least I'm not, and I don't believe you are either, is badmouth GMA. We're just simply saying you're paying a lot. Like that's
Correct.
all, and it cuts. It's not just hating on the bulls; it's also literally saying for the bears too. So instead of thinking, should I buy premium? Is it right to say, oh, I should be selling premium because you want to sell when it's expensive?
Yeah, or expressing my long via buying stock, right? Because
Gotcha.
stock doesn't have that same dynamic. So, like, okay, great. I want to be bullish. Maybe I'm already long calls. Maybe I want to sell some out of the money calls now, turn into a call spread and wait. Or you can adjust your position. There's this thing called event vol, which exists around data points or earnings, and essentially what that is the market prices in a premium due to the event. We don't know, what the event is going to be. We know earnings is the event, and so the price of options goes up simply as a function of there's this catalyst, right? And so 99 times out of 100 after the event, vol is going to drop. Like even
Mhm.
when Nvidia blew it out of the water, implied vol still drops. What does that mean for you? That means if you own options, you are paying that tax of volatility going down, right?
Okay.
And that makes it less probable that your option is going to pay off. And so you're going to go into the Nvidia event and saying, I think they're going to blow it out. I want to get long calls here. You could be right directionally again, but you're paying that event vol tax, which means that your calls are just automatically going to lose some percentage as a function of the event passing, which makes it what means that you have to be right times two or times three
Agree.
in order for that to pay off. Now you can offset some of that cost by turning it into a call spread or trading call flies or some other dynamic options positions, but you just need to know that going into these types of events. And the reason these tools help is because you can put this into context. Are calls expensive? Well, on your Discord channel, wherever people may be saying, no, they're not. But you can just look at the data here and be like, well, yes, they are expensive. Right?
Gotcha. Okay, so just to very, very quickly recap, I kind of explained how I'm using it with 0DT spies, and you said looking for the confluence. And then from there, the Microsoft position, now that I'm learning more, not feeling the most comfortable in, but I like that because it seems like you can identify cheaper or expensive and then swing it, obviously, the opposite way. But then does this bring us to a third realistic way to use this of coming into earnings of same thing, though, looking for expensive or looking for cheap? And then like is that something that you do is like, okay, I'm coming into earnings. Maybe you don't have a bias, but you're seeing premiums really, really expensive. So you're just selling like iron condors or something like that. Like, is that a way you like to do this?
Yeah, 100%. So before we talked about the call skew where out of the money calls and it looks like there's that upward slope, right? That is telling you, and if you think about this, what does that mean? Well, when the event comes out, there's a lot of these very expensive calls which are going to get sold. They're going to lose their value, which means that in theory, the market makers will have to start selling or they have a little shares to sell into that situation. So if you're seeing a skew, you may play that differently than if that term structure is flat. So what does that
Okay.
mean? That means if I see that big skew, I may more want to sell call spreads because I want to bet that skew flattens out. Whereas if the structure is flat like it is now, then maybe I want to play more of a neutral strategy, right? Because I don't have that directional bias. So the way I think about this is if you were to drop a ball where your mouse is right now, that ball is going to roll downhill, right? And in
Okay.
that situation, I want to bet on that ramp, dropping down. Whereas now, if you put a ball on that green line where the stock is currently trading, the ball's not going to roll anywhere, right? That whole level could deflate. In other words, we could just in a parallel fashion just deflate which means that that's kind of like an iron condor or a butterfly or something like that. If that makes sense.
Okay, so when it's going up like the gray line, I misheard you for a second there. So this is where you would actually prefer to sell calls for the opposite to happen?
Call spreads, to be clear.
Call spread,
I don't think
yeah,
you should
okay,
ever
yeah.
be short, making short options in earnings.
So,
Particularly,
and then on the current one, since we don't have that actual angling, you do more of like, I don't care if it's bullish or bearish, you're just like going to sell
more of a
both
neutral
sides.
strategy, betting that ball's going down.
Now, do you ever see the opposite where with coming into an earnings where there's a huge dip and you would actually prefer to do a put credit spread? Like, does that exist?
100%. Oftentimes you'll see, particularly like in the S&P, you'll always see a put skew, which means that out of the money, let's say 10% of the money put has a higher implied vol than the call. So that's more of a put skew, which always happens in the S&P 500. And you'll see that in sleepier single stocks. And so you go, well, is this expensive or not? There you have your shaded cone and you can evaluate that. So while you're looking at this, I would just note implied volatility, obviously, in the S&P 500, as you can see there, is very, very low. Nobody betting that the market is going to drop significantly. There's just no hedges on it. And so one of the fascinating things is even last week into April, while the market was like very weak, right? We were on that 5,000 level. That volatility never really increased, which told us that the big guys aren't out there buying puts, even though the market's so weak, right? And I think there was a lot of information in that.
Interesting. It's also kind of cool. I just had
add in the post implied volatility drop. So if you go to the term structure, if you go back to the video real quick,
NVIDIA,
there's a button on there. If you click the top right, it's called forward implied vol, which sounds complicated, but all this is telling you is if you remove the event, where should implied volatility go?
Where was this one? Is it in the three lines?
Slider there.
The term structure.
First one.
Oh. All right.
Cool. And just zoom out a little bit so you see more strikes in my mind. Sweet. Okay. So when you're looking at your black shows or options price or whatever it may be, there's an input for implied volatility, right? That forward implied vol is where we think implied vol is going to go after the event. So that's how much of a tax you're going to pay, so to speak, after the event. So you can go into a calculator, an options calculator, say the current implied vol for a 1 month option is, I can't quite see your screen there, but it's whatever the dark green line is, right, at the top of the cone. Yeah. After the event, volatility is going to drop to that lighter dashed line. So I can plug that into a calculator, an options calculator, and say, hey, I'm going to sell this iron butterfly at 100 vol, and then after the event, the condor implied vol is going to be 50. How much will that option make?
Interesting. Okay, so it's almost predicting that crush.
Add some predictive element to, hey, I'm trading this spread or this position around earnings. How much can I make or lose based on just implied volatility shifting?
So to execute something like that, would you actually wait for that date, or would you do it right before the date because that's when that's actually being priced in? So
I think you do it close to the date because you want the stock to be closest to at the money. If you put a position on now because of some macro reason, the options shift. It's if you're trying to be delta neutral, like I'm putting on a condor that's equidistant right around where NVIDIA is currently trading. Well, if NVIDIA goes down 2-3% next week because of some CPI information, then suddenly your condor is very skewed, right? So that's why I think you wait until even the day of earnings, right, to kind of put your position on, because you're trying to make a bet on volatility oftentimes here, not necessarily the direction of the underlying stock, right?
So to directly answer the question about NVIDIA, that's what happened was this right here was, even though they went in, this was the actual crush to the premium. So what you said before, they need to be like triple, quadruple, right, to even really make a little bit of money, because even though the strike was percentage distance so much closer, the extrinsic value of just volatility, it just got like right here. This was the literal devaluation of the premium. Exactly. Wow. Okay.
Big event means, highly anticipated event, a lot of demand, particularly in calls. You're paying a bigger tax.
Interesting. So this just really, really allows you. So is this more for equities, or if I brought it up for SPY? Okay, you could see that there's still like an expectation. And that makes sense because next week I'm reading all this. ChairPal speaks, retail sales, there's CPI. So once again, even though volatility is quote unquote boring right now, we're almost kind of predicting an expansion of volatility that then gets crushed the week after that as well. So maybe not this week, but next week might be ideal to sell premium.
Exactly. So when you're talking about, selling options today or Friday, there's no juice left to sell, right? And so you're talking about so much of trading is the avoidance of doing the wrong thing, right? Like And I think a lot of people come in like, I sell premium every day. Like, I got to do it again today. And you're just trading at prices that just don't make sense anymore. And so if all these tools do is they help you to figure out, hey, when are the stars all aligning? That is when I have the best probability of making money. That's really what you really want as a trader, right? Okay, like implied vol is cheap or rich relative to what I want to do. Hero flows are going the right way. The part of the option cycle we're in makes sense. Like when all those stars line up, I think your aptitude for success, really, or your chance of success, really increases. And I think that's really what trading is all about, right? Like waiting for the fat pitch, which can be really hard, especially in this age of, like social media and everyone's making money every day somehow on something, but wait for your thing to line up, right?
I think that's obviously excellent advice. And overall, this was so incredibly helpful. Obviously, I very much appreciate your time on a personal note. Before we let you go, would you be okay answering maybe 2-3 questions from the audience? Okay,
100%. Yeah.
Folks, if you have any questions for Brent about how he looks at the market, SpotGamma itself, life in general, I don't know. But we're running out of time here, so I just we'll make it quick. But any questions for Brent, SpotGamma, options? Obviously, we got into some complex stuff, so I would be very, very surprised if everyone's like, no, I already know it. I'm an expert.
I want to say one quick thing. We have twice weekly Q&As. We have Discord channel. We have all these resources because the idea is like, look, we think that this is how you should be looking at the market. And we understand that some of the stuff is a little bit of a higher level concept, but we think that you need to know them if you're trading options. So the idea is like, we don't want to dumb this stuff down for you. We want to like lift you up so that you understand all this stuff, right? Because we think it's really important. And so that's what the idea is. So if you feel like you got thrown to the deep end of the pool, like we're here to help you. We're here to help educate and improve the validity of a lot of these ideas.
Definitely, truly appreciate it. This one, how do you use SpotGamma? So I guess the question is, does it also work on BTC ETF? So would it work on something like the new, or is this only like an equity thing, or can we get these same types of Greek measurements? I don't even know if there are options yet on the ETFs technically, but in a theoretical world, if they were, would this also be applicable?
Yeah. So anytime you're talking about a stock that's driven by a commodity, which is, I think you said Bitcoin ETF, I view Bitcoin, let's just say for this purpose, it is a commodity. So if you're trading Coinbase or one of those ETFs, well, if Bitcoin goes up 1,000% or corn oil goes up 1,000%, like, the stock is going to go with it, or the related stock is going to go with it. But what you can do is you can look at the implied volatility of like Coinbase or MSTR, some of these other names, try to figure out, are these cheap or rich, right? And what is the market pricing in? We do not have cryptocurrency in our platform, something we're considering, but we're not really close on that at all, but we've been looking at that. But you can use if there are options on it, like a lot of the ETFs there are, not just in Bitcoin, but individual commodities that you can use these tools, exact tools to help you evaluate. Because look, if you're trading like oil options or something like that, those vols are going to be generally speaking, equal to whatever the actual commodity implied vols are, right? If not, there'd be kind of an arbitrage there. So you see a lot of synchronicities across that space. So we were using it to look at, for example, the Chinese internet stocks, right? They were going just bananas last week. And at some point, the calls get so expensive, you go, look, like, you can't pay off anymore, kind of like the NVIDIA examples. And so people have now overpaid for all these positions. It's a sign that consolidation is warranted, right? And you can find these themes oftentimes. Like in gold, it worked great, GLD and SLV a few weeks back, where you go, look, you can't buy a call and make money anymore. It probably means that the stock's due for a little consolidation.
All right. Awesome. This one's easy. How can we follow SpotGamma? In the description of the video, I have SpotGamma's Twitter. So if you want to know what they're up to, and I'm sure you could get assistance if you message them and whatnot. So that's in the description of the video. What's this other one? Actually, I think I might even be able to take this one of the different colors for calls and puts. So I believe what I was showing you was on Hero, which is the real time. So in the top here, you see the total. So there's 3 colors right now. There's the white, which is the price line of the S&P 500, the lighter green line, which is just for 0 DTEs, or really the next expiration, but on SPY would be like today's. While the purple is all. So it's not only today's, but it's Mondays, Tuesdays, Wednesdays. It's the whole Delta situation put together. together, but you also have the ability to split it into obviously the two parts, calls and puts. And that's why you then have 5 lines in total. Obviously the price line's 1, but then you have 0 DT calls, longer expiration calls, 0 DT puts, longer expiration puts. Did I get that right?
Yep.
Okay.
100%. And here's why that matters, just real quick if I can. If people are buying calls, particularly longer dated calls, that means that there's a hedging obligation out in time, right, for whatever the position is going on. So if a lot of people are buying longer dated calls, that means that the dealer hedging impact or how much dealers have to hedge actually will continue and increases as the stock goes up, right? So that's more momentum. However, if people are just selling puts, that creates some initial demand for market makers at the buy stock. But because a put starts to go to 0 as the stock goes up, that means the hedging demand wanes. Does that make sense? So the future momentum is not the same. And that's why it matters when you break down calls and puts. I realize that was a lot, but it's just one of the reasons like, hey, why does this matter? Well, that's the reason. And we'll pound that in your head over the next few weeks when hopefully y'all come and join us.
Awesome.
Last thing I would say too is that flow matters after earnings responses. So like Starbucks, Uber, Shopify, those things all got crushed over the last couple of weeks after earnings. When you go into here and you say, look, the stock is down 20%, everyone's selling their puts, or the stock's down 20%, no one's buying puts, that tells you that of the, I think there's 13,000 hedge funds, right? There's all this incredibly intelligent people out there, you know, PhDs, rocket scientists looking at these names. Stock's down 20%, no one wants to buy puts. Well, that's a great sign that maybe this thing's bottomed out, right?
Okay. That's a whole nother way I didn't think to use it, of like almost the lack of bearishness means like potentially a bottom. That makes sense.
Right.
That makes complete
sense. A lot
sense.
of that is like you want to catch a falling knife, right? But we want some extra, you want to try to catch a falling knife. You want a little extra confirmation, right? And so you can use a lot of the tools in here to figure out like, okay, look, I know that Starbucks dropped 20%. There's no more puts positioned down below. No one else wants to buy puts. I feel way more comfortable buying that than in a situation where you can see people are continuously buying puts. Forgetting dealer hedging mechanics, just if sentiment is no one wants to buy puts, they don't think the stock's going down anymore, then I feel a lot better about buying that major dip, right?
That's awesome. The final question here, is there a discount code for SpotGamma? I'll take care of that right after. I'm sure I just want to be respectful of your time, but I did get the link from your team, so I'll make sure to go after that right after. But overall, this is so incredibly helpful. If you're up for it, just because like you're saying that, like I agree, NVIDIA is crazy and whatnot. If your schedule's up for it, and I'll get this in DMs, but if you want to come back like the day of NVIDIA and give us a real-time breakdown, I would love it. The audience would love it. I'm going to check with you and your schedule and everything, but is that something you'd be up for?
Totally, 100%. I'd love to do it.
Okay.
That's also VIX expiration, which
so there's a lot going on, so it's perfect.
Independently looking around, check out how the market moves around VIX expiration. I'm talking about S&P. Just look it on your trading view chart or whatever platform you use. Okay. You'll see the market makes really weird moves around VIX expiration, which just corroborates the idea that options expirations matter. So we have the morning is VIX expiration, and then the evening is NVIDIA earnings.
Very, very helpful. Honestly, I can't thank you enough. This is, like you said, this is just the real thing you have to do to be successful. It's one thing to get lucky once or here, like I feel like I did a little bit recently, but if you want to make this the marathon of trading and survival, this is just the game. This is what you have to learn. This is who you're competing against. So the fact that your team have put this together, and then you've personally taken your time to like explain it to like the dumb retail traders like we are, to make things just make a little bit more sense. It does mean a lot to me. So once again, appreciate your time. Folks, if you want to know what SpotGamma is up to, what they're doing, like I said, the Twitter is in the description of the video. And then I also did see this one comment. I don't know who it's from, but right before this, they did send me some information that I'll cover with you guys in a second. But Brent, thank you. It sounds like we'll be seeing you soon. I'll follow up you with after this just to get the schedule and take care of. But obviously, enjoy your weekend, and thank you so much for your time.
Awesome. Thank you, and thank everyone for joining and listening to me talk here. Hopefully it was helpful.
All right. Have a good one, Brent. Thank you.
See you soon.